A really warm welcome to all of you, and thank you so much for coming to watch the video today. We have a fantastic look at how a massive logistics player is handling a very tricky freight environment. Today, we are analyzing Old Dominion Freight Line's Q4 2025 presentation.
Yeah, thanks for being here, everyone. It's a really revealing presentation.
It really is. So let's just unpack those prepared remarks first.
What?
Looking at the financials, Q4 revenue came in at $1.31 billion, which is down 5.7% year over year.
Right, but despite that, they managed an operating ratio, or OR, of 76.7%.
Which is wild considering they took a 10.7% drop in LTL tons per day.
Exactly. But their yields actually improved. They held direct operating costs at 53% of revenue and delivered a massive 99% on-time service rate.
And looking ahead to their 2026 outlook, they are cautiously optimistic about a demand recovery.
Because they are sitting on 35% excess capacity in their service centers right now, they are completely primed to capture market share the second volume returns.
Yeah, and that 35% spare capacity really drove the Q&A session. Let's get right into the analyst questions. Jordan Alliger from Goldman Sachs asked about indications on demand and Q4 to Q1 margin seasonality.
The company pointed to positive signs recently. Weight per shipment actually increased to 1,520 pounds in December, signaling a potential demand turn.
Next, Chris Wetherbee at Wells Fargo asked for the Q1 sequential OR and revenue expectation.
They're targeting Q1 revenue between $1.25 billion and $1.3 billion, with an OR increase of around 150 basis points.
Which led Scott Group from Wolfe Research to ask what's driving that weight per shipment improvement and the yield trends.
It's basically broad growth across customers. Higher weights do put slight pressure on revenue per hundredweight, but they achieve the real goal, which is higher total revenue per shipment.
Makes sense. Ravi Shankar at Morgan Stanley then asked if the share shift from LTL to TL is reversing.
Yes, it is. Truckload capacity is rationalizing, and Old Dominion has the capacity ready to capture those returning volumes.
Ken Hickster from Bank of America asked if falling headcounts and shipments are decoupling and whether the fleet is aging.
Actually, the fleet age improved to 3.9 years. They plan to flex current staff hours up to meet initial demand surges before they add any new headcount.
Smart. Reed C. from Stephens asked what is driving their lower CapEx expectations.
That's a function of heavy past investment. They spent $2 billion over 3 years. The network is already built to handle over 55,000 shipments a day.
Even though they're only handling about 40,000 right now. Jason Seidel from TD Cowen asked about the cadence for driver and dock worker pay.
Annual raises happen in September, and fringe benefits will make up about 41% of wages in 2026.
Jonathan Chappell at Evercore ISI asked about rolling that Q1 seasonality forward to get the full-year tonnage and OR improvement.
They're taking it quarter by quarter, though historically Q2 sees a 7% sequential revenue jump and a 300 to 350 basis point OR improvement.
Eric Morgan from Barclays wanted to know how higher weights and shorter hauls will impact pricing cadence.
Normal seasonality suggests 4 to 4.5% revenue per hundredweight growth. They emphasize that heavier shipments are highly desired even if they pressure that specific metric.
Risha Hernane at Deutsche Bank asked what caused last week's disruptions and about incremental margin expectations.
A snowstorm caused the disruptions. They're expecting roughly 47% variable incremental margins initially as volume returns.
Tom Wadowitz at UBS asked if customer feedback actually matches the recently huge ISM print.
Customer feedback is positive, but maybe not quite as extreme as the massive ISM jump suggests just yet.
Bruce Chan from Stifel asked a crucial question. Does that 35% spare network capacity also apply to the fleet?
It doesn't. Fleet capacity is kept much tighter to avoid a depreciation drag. About $105 million is slated for equipment right-sizing this year.
Ari Rosa at Citigroup asked how competitive dynamics and industry capacity look for this cycle.
Industry service centers are actually down 6% since 2022. But Old Dominion owns 95% of its doors, providing a massive structural advantage to outgrow peers.
Jeff Kaufman at Vertical Research asked what they're seeing with equipment, quoting activity and tariffs.
Tractor costs are significantly higher than a decade ago, but tech and operating efficiencies offset this per-unit inflation.
Brian Ossenbeck from JP Morgan asked if cost per shipment inflation is still 3.5 to 4%, and if private companies absorb the excess capacity.
Core inflation is actually closer to 5 to 5.5%, mostly driven by wages and healthcare. And the industry remains capacity-constrained overall.
Stephanie Moore at Jefferies asked which end markets are driving the customer optimism.
They are 55 to 60% industrial. They're hearing that inventories are low and need replenishment, but it all relies on a healthy consumer.
Finally, Christopher Kuhn from Benchmark asks if there are any specific AI initiatives underway.
Old Dominion focuses purely on practical tech investments that drive proven operating efficiencies and customer service. They actively avoid empty buzzwords.
So to wrap up this deep dive, the main theme is clear. Old Dominion has successfully defended its margins and service levels through a freight recession,
Yeah, by aggressively investing in latent capacity, they are tightly coiled to absolutely dominate market share when demand fully returns.
which brings up a really provocative thought for you to explore. Old Dominion views technology as a quiet, decades-long operating advantage rather than a trendy buzzword.
It really makes you wonder how much untapped efficiency is still hiding in the legacy logistics world, just waiting for the right tools.
A fantastic point to end on. Thank you all so much for watching. If you enjoyed the video, please click like, share the video, subscribe, and stay tuned for upcoming content.